Samuels. Now, Jody is the founder of FX Traders Edge and is an acclaimed author as well as one of North America's leading trading coaches. Her specialty is guiding traders on developing proper trading skills and habits so they are equipped to navigate the real-life emotional and psychological effects of market chaos. And I think as traders, we certainly can understand that last statement. In today's presentation, she's going to be talking about a 3-step playbook for making consistent profits. She's going to be sharing an analysis framework for finding the best market moves, an entry setup checklist for trading in any time frame, and proper position sizing, profit target, and stop setting. So once again, extremely important topic. We're delighted to have Jody with us. Jody, good morning, good afternoon. Welcome. The floor is now yours.
Good afternoon, Raleigh. Good to see you, and thank you for having me on.
Oh, you're welcome, Jody. It's always great to see you.
Yeah. All right. Screen check.
Absolutely. You sound good, and we see your screen. So you're ready to launch.
Okay, perfect. So today we're going to do something, a 3-step playbook for making consistent profits. Here's a disclaimer to read. And that's me. That's my book, The Trader's Pendulum, The 10 Habits of Highly Successful Traders. I just like to start with this because I'm very proud of that accomplishment. It's my first and only book. All right. So this is what we're going to talk about today. How to anticipate market direction by reading the market map is really, really important. I'm an Elliott wave strategist. It's really important to be able to read the market map, to understand when we're in an uptrend, a downtrend, a sideways market. It just helps a lot. So we're going to go through that today. And then I'm going to show you an actual strategy, a simple strategy called the 4 lenses, how to locate and trade with confidence, high probability setups. And that is really what it's all about, weeding out the low probability setups, whether you're trading, whatever asset class you're trading, whether you're trading, options, stocks, Forex, commodities, it really doesn't matter. It's the same. And how to trade these setups for maximum profits. So risk management and trade management. We'll touch on that. This is important to know because the markets are volatile, especially now. And there are just so many trading opportunities. And emotions are the Achilles heel for traders. So you need a system that removes the emotions. I can't tell you how many people have made sessions with me just to talk about their emotions gone awry. Jody, I took I really don't. I took over 100 trades today, and I'm thinking, how can somebody even take over 100 trades in a day? But I remember back to my early days trading at the bank, and yeah, I mean, if you trade all day, you can certainly rack up that many trades, but certainly if you do, you're going to experience the emotion. So you need to filter out the bad trades. And if you're planning to adopt automation, you need a foundation first. And your capital is likely limited. So it's really important to have a system. A little confession, I've been trading for more than 30 years, and you might think that I have an advantage over most traders, and to a certain extent, you are right. And in case you don't know me well, I traded currencies for 14 years for JP Morgan in New York and Toronto. So I traded the British pound from 240 down to 105 and back up to 140 profitably. And that was during the days when the markets were so very, very volatile. And it's just today's markets are just bringing back such memories, and I want to say fond memories, and I'm loving these markets. What can I say? And I've actually gotten back into day trading a little bit. I've been trading 20 plus years as an independent retail trader, just like you, commodity futures and Forex. And now I'm trading stocks and options. So if you are starting to think, oh, trading must be easy for Jody, but not for me, well, I also hit a wall after leaving the bank. On the one hand, I was confident with my bank experience, of course, but on the other hand, I had doubts and uncertainty, just like you, just like anybody else, because I didn't have access to the bank support. I didn't have access to my you know, my traders and the flow of information, because once you leave the bank, and you leave the information with the bank. So when I set up my own trading account back then, I had to pay $2,500 a month in data and chart fees. Could you imagine? I traded futures because there was no established Forex retail market yet. What process did I follow to remove any hint of doubt, uncertainty, and to overcome starting the month $2,500 down and to become finally an established and profitable retail trader? Well, that's what we're going to talk about today, the three-step playbook to achieve consistent profits in your trading. And this playbook includes the analysis, the strategy, and trade management and risk management. So these three pieces we're going to cover today. And by analysis, I mean the market map. We're going to study the market map together. And by the strategy, I mean the four lenses checklist that I'm going to teach you today. And then trade management is trade management. We'll talk about that with optimal risk reward. So let's get to the analysis, the market map. The first step in achieving consistency is to have a thorough knowledge of the market to determine future scenarios and be prepared to take advantage of the opportunities that arise. And in our system, we use the market map in order to provide market context and increase the likelihood of successful outcomes. So for example, this market map works for any market. And I mean, if we look, we had some very clear moves today in the stocks. In the indices, and they followed they followed the market map. So let's see what the market map is for an uptrend and a downtrend. So first we have an uptrend move, a 5-wave move up, followed by a 3-wave move down. And the beautiful thing about understanding the market map is that really we're talking about trends and corrections. And since all corrections are labeled as 3-wave moves, ABCs, and the first 3 waves of a market trend is also a 3-wave move, but it's labeled 1, 2, 3. The good thing about this is that as a trader, you can trade all 3-wave moves. So that means that if we start up here and if we have an impulsive move down, meaning a trend move down where we have all red candles, for example, and then we have a sideways market consolidation, we can anticipate another move down to match the first move down. And that's what we had in the markets today. We had down moves, consolidation, trend continuation, down moves in many different instruments today. So just great trading day. If we are moving down initially, well, then we would expect a 3-wave move. So this is the 8-wave market map, the 8-wave market cycle. And I use this every single day in my trading. I can look at a chart and I don't need the 8-wave counts on the chart. I'm just seeing these patterns that are jumping out to me. And you know, that's what you can become once you study these cycles. You can become, I want to say, an intuitive trader in a sense, once you get more experience behind you. So to the right, we have an example of using our Wavy Tunnel Pro and trading strategy and how the market map looks like. It looks like the market map to the left, where we have the 5-wave move up followed by a 3-wave move down. So if you can recognize this pattern with no matter what setup you're using in the markets, you should be okay. And not all patterns look the same. They don't. So you want to find your ideal patterns and your high probability setups. So if you can see this pattern over and over again, then you can capitalize with it. You can make money with it. So let's just go through the market map quickly and show you what trades you might want to focus on. Starting from the lower left, trade number 1 would be after we have the initial move up, the trend move up, and then a sideways consolidation or a retracement. And it can be a steep retracement. Sometimes it is, and sometimes we double bottom. your first trade would be to buy the next leg up for the wave 3. And you can buy that on a break of wave 1. You can buy that on the wave 2 retracement. You can buy that going down to a smaller time frame and getting in once it starts to reverse. You can get in however you want to get in. So that's trade number 1. Trade number 2 would be waiting for the market to come back. If you're using some moving averages, you want it to come back to the averages, and then you would go in again for the wave 5, the next move up. And then the trade number 3 is to either sell the move down from after we've reversed, or to wait for that initial push down followed by a retracement or a sideways consolidation for that third leg down. So it's very similar at the start of the market move and after we find the end of the trend and we come down for a correction. So Ralph Nelson Elliott is the guy that studied various market indices over a 75-year period in the 1930s. Before we had computers, he had an illness, he was bedridden, and he discovered that stock markets traded in repetitive cycles by poring over, I don't know, thousands and thousands of stock market data. And these cycles or waves reflected the emotions of investors. The other guy that's well known is Fibonacci, Leonardo Fibonacci. You're all familiar with him. And Fibonacci numbers, the sequence, and then the ratios are all used in determining market targets, market pullbacks, and it's very big in Elliott wave analysis. So this is the 8-wave market cycle that we just spoke about. And if you break it down, you see that we have numerous 8-wave market cycles. So that means that if you're trading on the 1-minute chart, if you're day trading on the 1-minute chart, you can actually, you would be trading maybe this piece here, right? Or this piece here in the downtrend, I guess we had, downtrend today in many markets. So this is the 8-wave market cycle. It works on the monthly chart, the weekly chart, the daily chart, the 4-hour chart, the 1-hour chart, the 1-minute chart, and on any instrument that you are trading. So now let's talk about the actual strategy, the 4 lenses checklist for pulling the trigger. And this is the second step in the playbook. It's really important to have an effective strategy so you don't just wing it, which is easy to understand when making a trading decision. And after a good analysis, strategy is used to identify the exact entry point, the stop loss level, and the profit target to know when to trade and when to stay out of the market. Especially if you're swing trading, you want to have a sense of how far the market can go. Because if you have that sense, and the only way to get that sense is to look at a bigger time frame, if you have that sense, then you have the potential to ride that move a little bit longer than you might be used to riding it. And removing the emotions is key. Certainly, if you're day trading, you want to go with the flow of the market, but it's also good to have a target, and how you have that target is to look at the bigger time frames. So let's get to it. This is the uptrend followed by the 3-wave correction. I'm showing you the checklist for the point T end of trend move, where we see a reversal candlestick pattern up here. We look for divergence or a major peak in the awesome oscillator. We have a trend line break, and then we use the 1, 2, 3 reversal to get into the trade. And because we're having huge moves right now in everything, we are seeing extended moves. So when you do look for these patterns, and you do have that trend line break, we do see moves that follow through. And I just want to point out, why is a trend line break so important? Well, look at this move up in the trend surrounded by channel lines. Most Elliott wave trends can be go within the channel line. So when we do have the trend line break, we have a move in the opposite direction. It is a trend reversal. So let's just look at an example. Okay, this is the Aussie daily back in March when all of the markets, reacted the same way. we start with a blank chart. We have a reversal candlestick pattern, and the reversal candlestick pattern here is a long tail. I mean, this is the daily chart. So it's a long tail. The market sold off, and then the sellers came in, sold it way down, and then the buyers came in, and we actually closed in the middle of the trading range, in the middle of the range for the day. So this is a bullish pattern only because the buyers rejected the sellers, and the market closed pretty well at the opening level of the day, and then we see what happened from there. So you're going to look for a reversal candlestick pattern at market tops and bottoms. And then you're going to use the awesome oscillator and use the standard settings, and you're going to look for divergence or a major peak. In this case, we had a major peak because the market just collapsed, and all of the markets either collapsed or moved higher, depending on what, in the currency, some actually moved higher, but obviously in stocks, everything came down. So this is looking for divergence, and you can see the awesome oscillator trading well below the zero line. This is the zero line, and the histogram is showing increasingly lower histogram bars. The third is the trend line break. You just simply put the trend line on, and that's the third step. So this is a checklist that you're going to look at over and over again when you're looking for trades. And then I'm moving down to the 4-hour chart because I say 1, 2, 3 reversal on a smaller time frame. If we go back up to this, it's not so easy to see a 1, 2, 3 reversal. It's much easier to move down to the lower time frame to see the 1, 2, 3 reversal. And we actually have two. We have the major one here, 0.1, 0.2, 0.3, and we don't close above this 0.2. So that's the 1, 2, 3 reversal. The one is at the start, the end of the trend move, and then the market moves up we label that 0.2, the market retraces, we label that 0.3, and then the market moves above 0.2. That would be the trend reversal, where we have higher highs and higher lows after seeing lower lows and lower highs. You can't really see the 1, 2, 3 reversal over here, but this gave us a 1, 2, 3 reversal again. Maybe on the hourly chart, the market came down and we had a nice move up, a move down, and then the market went above this level here. So in our example, we're using the second 1, 2, 3 reversal. Now let's look at, I'm just going to move over to all of the Aussie crosses, because if you're trading Forex, you're going to see the same patterns in all of the crosses related to the Aussie dollar. So we have this tail in the Aussie on the same day. We have this reversal pattern. This is an engulfing pattern in the Aussie Kiwi. We have a long tail in the Aussie yen. We have a long tail in the Aussie Canada. We have a long tail in the Euro Aussie. Now this is a topping tail. This is a top because Aussie is in the second place, the Euro is first, and all of the other currencies, the Aussie is first. So that's why the Aussie sold off relative to the second currency. In this case, the Euro strengthened relative to the Aussie, so the Aussie sold off. And then the Aussie Swiss, it's quoted first, so we have a long tail here. Everything happened at the same time. Just wanted to show you that. So that's step one, looking for the reversal candlestick pattern. And then step two is I went down to the 4-hour just to show you what it looked like and drawing the trend line. It's the same kind of deal, like going down to the 4-hour, drawing the trend line and looking for the 1, 2, 3 reversal pattern. You can see the 1, 2, 3 reversal pattern to take the trade, to trigger the trade on all of these markets. Now, these markets are correlated, obviously, because we're talking about the Aussie dollar vis-a-vis the US or the New Zealand or the yen or Canada, the Euro or the Swiss, and you can decide which markets you want to want to take. You can take your trade just on the Aussie dollar, or you can take it on a few different currency pairs. So I just follow very specific criteria in my 4 lenses strategy to evaluate if I want to trade a specific setup. I remove subjectivity with the specific criteria. The greater the objectivity, the fewer the emotions. That is so very important. If we can make our strategy objective, and you can have a checklist, like a simple checklist, like I just showed you, and we're gonna look at more examples in a moment. But if you can make it objective and then just look for trades, look for setups, look for trades, look for setups, and then pull the trigger, you're quieting your mind. You're quieting those emotions. And that is so important as a trader. That's why you want to get really good at finding the setups that work. If it's boring, that's a good thing, right? If it's not boring, well, if the strategy is boring, that's a good thing. Meaning, if you are finding that the strategy is working, you're finding the trades and you're making money, that's a good thing. If you want to practice another strategy or learn about a different market, practice on a different account, but make your real account what you're focusing on with the strategy that you feel comfortable with. So trading is really all about evolving as a trader. We learn from our mistakes. We learn from our emotions. Like, I just can't tell you how much I've learned over these 30 plus years. And I'm a really good trader. I am a good trader today. Okay, the Wavy Tunnel Pro strategy has what I've always been looking for, namely clear, defined, understandable, and consistent rules that are not complicated to learn. Even people who have never had anything to do with the stock market can learn these strategies quickly. So Christian took the Wavy Tunnel using the stock market. Well, you just learned the simple strategy, the 4 lenses checklist for pulling the trigger. Now I want to talk to you about trade management and optimal risk reward for achieving consistent profits, because this can make the difference between a profitable trader and an unprofitable trader. And it's going to be different for if you're trading more short term than more long term position taking. And I'll tell you one thing about these markets is, I don't know, day trading is coming back because the markets are so volatile, and it's really very easy to make your money in a day. Like, you make your money in a couple of hours. It's easy because the markets are so volatile. Before this in the last, I guess, before 3 months ago, the markets may have been settled down, quieter. I know in Forex, the market, you would take a position and sometimes it would take, a couple of days for you to see your profit targets, 2 to 3 days. And now we're able to see profit targets within the day pretty quickly. So let's just talk about this third step in the playbook, trade management. The goal is to apply optimal risk and money management and trade management in order to maximize profits. This step can tip the balance between being profitable or not. So for example, by trading only setups with a minimum risk-reward ratio you set in advance, like 1.5 to 1, you can refine your analysis and improve your performance stats immensely. And you can then have a smaller win-loss ratio. So I know there are a lot of traders that talk about like an 80 to 90% win-loss ratio. So they're winning 80 to 90% of the time. That's terrific. Like, that's definitely a winning trader. The other thing that you can do is you can look at the size of the win versus the size of your loss. If your wins are much bigger than your losses, then you don't really need an 80 to 90% win-loss ratio. You can have like a 50 to 60%, for example, win-loss ratio. So you can really work on that in your trading after you've mastered your strategy and you're making money. That's like the next level to work on. So let's go back to our example. The entry point, this is the trade plan. The trade plan is when you establish your entries and your stops and your profit targets. So your entry is going to be up here at 0.2, 58.45. Your stop is below 57, the low of this 1, 2, 3 pattern. And you have 145 pip stop loss here. That's 58.45 minus 57. That's 145 pip stop loss. So that means that we're going to be looking for, pretty significant profits. So let's discuss how you can set your profit targets. What I do is I use the Fibonacci tool and I run it on the previous swing move. So I'm running it on the previous swing move down, and the Fibonacci target is coming up with, the retracements are coming up with 38, 50%, 61.8, 78.6 with these retracement targets. So for one trade, that's really what I'm looking at. I'm looking at either a 38.2, 50% or 61.8% targets, or on the next slide, I'm going to show you different targets. Now, the reason why I choose 3 targets is because if I don't choose 3 targets, then I may get out of my position too soon. So I might take the trade and see that I'm making money and get out of it too soon. And that's really not a planned trade. For me, a planned trade is looking at what the ultimate target is. And my ultimate target in this example would be the previous high. And then working backwards to see, okay, let me set 3 profit targets. And one way to do it is to use Fibonacci. I have other ways as well, but I'm just teaching you this way. So one set of profit targets would be the 38.2, the 50%, and the 61.8% retracement of the previous swing move, which are these prices here. The second is to say, okay, I'm looking for 100%, so my third target is going to be 78.6. And then you work backwards, 78.6%, 61.8%, and 50%. And those are the 3 targets, okay? And just looking at the chart, 50% takes you here, 61. So then we move up higher. We don't get triggered at 61. It comes back down again, and then it moves up and you get filled at 61.8 and 78.6. So there is a lot of patience involved when you are trading off of the daily chart, but I'm only showing you this as an example. This could also be the 5-minute chart or the 15-minute chart, but you do have to set your profit targets accordingly. You're going to make smaller profits. The other thing that I want to say is, yes, I said that you do need to have a lot of patience, which is why if you have 3 different profit targets, if you're getting filled at this 50% on a third of your position, and then it moves up more and then it comes back down, you've at least taken some profits, and you're still in profit because this is your entry point. So here we have the trade plan results using the first example of 38.2, 50%, and 61.8%. Because it's a daily chart, this is a 12-day hold. And if you take 3 positions, and I'm just saying 3 standard lots, 3 mini lots, that's how I've defined it here. A standard lot is a $100,000 position. A mini lot is a $10,000 position. You do not, in Forex, you don't need to have that amount of money in your account to be able to take these positions because of leverage, but that's a whole other topic, and you really need to be familiar with it and trade on demo for a while so that you're absolutely clear on what you're risking. The time frame, 4-hour, because we went down to the 4-hour, you have your entry, your stop, that's your 145 pip stop loss, and then our 3 profit targets, which we can see over here. So all I've done is, this is the average profit because we took equal positions for P1, P2, and P3, equal size positions. And this is how I calculate the risk reward. It's 1.75 to 1 because the average profit is this, and based on the entry point, and our stop we know is 145 pips. It comes out to be 1.75. If we move down where we take our profits at 78.6, 61.8, and 50%, and here I'm really just giving you a framework, okay? This trade took 16 days to materialize, to finally hit the profit targets, and then the risk reward is higher. It's 2.84 to 1. So this produced more profits. Why? Well, because the profit targets were set higher, right? So the first trade, 12-day hold. Second trade, 16-day hold. I'm giving you this framework so that you can follow it and use it when you're taking your trades, no matter what time frame you use. And like I mentioned earlier, you don't have to trade on the daily chart. Now, there are people that are working full time, those that have their jobs, and they may be more interested in trading on the daily and the 4-hour charts. So I want to show you how.
Hey, Jody, Jody, it's Raleigh. I just want to ask you a really quick question before you move on there. Those are some great examples, trading like multiple lots going forward. With regard to your stop, do you keep it fixed there? Do you trail your stop at all as it moves up? What are your thoughts there?
Okay, so I didn't talk about trailing the stop, but let's that's a good point. Let's talk about it. So let's just go back to the. Okay, let's look at this and talk about trailing the stop. It's what I would say to do is once you take your first profit target, you can move your stop to break even.
Okay.
So that way you're locking in your profits and you're not going to have a losing trade. Because we have 3 profit targets. It's easy for it to move in profit and have the first profit target triggered and then have it go against us. And you certainly don't want to take a loss once you're in profits. Like that's a no-no, right? So move your stop to break even as soon as the first profit target is hit.
Okay, makes sense. That's what I would be doing, but I wanted to make sure that was consistent with the way you looked at things, Jody.
Yeah, no, absolutely. Great question. Yeah, and keep asking the questions if you have any more.
Sounds good.
Okay, so let's. Yeah, so this is. I originally showed you the chart, and this example runs out over here, right, on the Aussie dollar. Look what happened into today. Like I took this chart this week. So the market kept moving up. So then you might say, well, Jody, you took your profits way too soon. Like, look at how much you could have made. Would have, could have, should have. All right, we'll address that in a second. Let's just move on. The Aussie Kiwi also. Look at how much more it went. The Aussie Yen, look at how much more it went. Because like I've said, we're in significant trend moves. The Aussie Canada continued on up. The Euro Aussie continued on down. The Aussie Swiss continued on up. Most traders will not be riding this big of a move. So there's nothing wrong with taking your profits along the way. But if you have a good market that you were successful in, let's just stick with the Aussie dollar. We took our profits over here. How do you know that it's going to continue on up? Well, in Elliott wave analysis, if you have a 3-wave correction, and we did right after that market peak, a 3-wave correction, then you can start to look for the next move up. It's likely that we are not having a market reversal to trade lower. A 3-wave correction is very much a continuation pattern. You can call it a flag pattern. So this is the daily chart. You would go long again after the 3-wave correction, after we started to move up again. And you could use, again, the same methodology, looking at a 1, 2, 3 pattern. So this is really a continuation of the same view, of the same trade. Let's look over here. The market moves up and it pulls back. Also a 3-wave correction. This happens to be a sideways move. This first correction is more of a zigzag move. So this is a sideways correction, still a 3-wave correction. And then the market continues on up, corrects, moves up, corrects, and moves up. Now, we are at a point in all of these markets where I would look to draw the trend line and look at the awesome oscillator and do the same thing for a change in trend. We are at a point where we are in a change of trend position. And so what do you do? You look for the reversal candle on top, you draw your trend line, look for the trend line break, look for awesome oscillator divergence or peak, and then do the same thing for the market reversal. So the longer we stay, look at how long well, everything is different. With the Aussie dollar, we've already moved down and we have done a three-wave move back up. So just looking at this time frame, if we break down below this low, if we label this as a 0.1, 0.2, and 0.3, if we break down below this low point, then we're probably going to go down a bit. Okay? So you can do your own analysis for all of these other markets, but it looks like we're getting ready to roll over on some of these markets. Can't be sure, but that's what it's looking like to me.
So on these charts, Jody, that we're looking at here, where we're looking at all the 6 Aussie pairs that you have here, do you have a favorite Aussie pair that you like to trade and you look at the other charts for confirming signals, or you like looking at all of them and you'll choose which pair thinks has the best opportunity from you using your 3-step approach?
I would look at all of them and just pick one, usually one.
Okay.
Yeah, 1 or 2, because these are all correlated. But the Aussie dollar is moving quite nicely. I mean, because we're having dollar moves, I would just go with the Aussie dollar. It's just great, especially for people starting out if they're not used. I know I speak to a lot of traders that don't really know a lot about the crosses. As long as the dollar pairs are moving, you can trade the dollar pairs. I'll tell you, when I traded the British pound dollar at JP Morgan, for a long time, when I traded it from 240 down to 105, back up to 150, the volatility was enormous, and I love trading the British pound. But then there was a period of time when the pound traded in a range. So what I did was, I was on the trading desk as one of the traders. What I did was I still had to quote interbank. At that time, we had to quote to the other banks asking us for prices. We had to quote to the customers. But what I did was I took cross positions. So I had, at that time, it was called the Deutschmark then. I had the Deutschmark traders sitting next to me. I had the yen traders sitting across from me. So I took now it's the euro pound. So I'll just say euro pound. I took a lot of euro pound crosses and a lot of pound yen crosses during my trading day because those were the ones that were moving the most. The euro, well, at that time, the Deutschmark was moving so much. The yen was moving so much, and the pound dollar wasn't moving as much. It was the crosses that were moving. So really, this changes over time. Now, I would say the dollar pairs are moving. Go for it. Just trade the dollar pairs. A year ago, I would have said dollar pairs aren't moving. It's not clear. Look at the crosses. So that's a very long-winded answer to a very simple question.
No, but that's great because it really gets into the, it really discloses your thought process on this. Because I think a number of us like to think that we have a checklist that we go through, and the final one might be looking for confirmation. Everything else sets up, and then you look at these other slides and you say, and I see all these confirmations, and I'm going like, wow, this is great. You've got these 6 that are up here.
Right. Okay, so I'll just give you another example for people that are trading stocks. I'm doing this FANG challenge. So every single day I am day trading the FANG stock. So Facebook, Apple, Amazon, Google, Netflix. And am I going to take a trade in all of them at once? No. I'm looking at all of them as if they were like cross. It's very weird, but I'm taking my Forex experience and I'm able to look at the ones that are the strongest or the weakest and if I'm bearish, I'm going to maybe sell the weakest. If I'm bullish, I'm going to buy the strongest. So I'm able to do this from my Forex experience, and it's similar. It's just very similar. Am I going to take all of them? No. But am I going to look at all of them? Absolutely yes. And I'm going to try to take the one that's moving the most. So whether you're doing stocks or whether you're doing Forex, it's sort of a similar process.
Sure, and I
Yeah.
think to that point, that's one of the questions that came up a little bit earlier, is that, you know, the 4 lenses checklist that you use, the approach that you're using with the wavy tunnel, et cetera, can be applied. Is it safe to say that it could be applied in any market, whether it's
Oh,
futures or
totally.
stocks? Yeah, okay.
Well, I'm trading the FANG stocks. I'm
Sure, of
using
course,
the wavy
obviously.
tunnel. I am
Yeah.
absolutely using the wavy tunnel. It's totally the bomb. Like for me, right?
I wish you weren't on the fence about this.
Yeah, I know. Well, yeah, I know. Because the wavy tunnel, it incorporates the Elliott waves. I don't like to sit there and count the waves formally, but I do like to see the market unfolding with its waves, and I can just do that by looking at a chart and using the wavy tunnel. So.
And that was another question that came up here quickly. I don't want to derail what you're saying, but it's a good point to ask this. I'm looking at your charts, they're very, very clean. I don't see an awful lot of indicators and things. Is this what you're looking at? I saw that one slide that you had the awesome oscillator on there.
I'll show you the wavy tunnel setup in just a minute.
Sure.
So these are clean. Yeah. So there is more of a, like with Elliott wave analysis, you are following the price action, but I use the wavy tunnel to look for targets, to see the triggers when I'm going to enter. But so I need to have it on the charts, and I do, but I don't have it on these charts. But I'll show you what they look like. Okay.
I see. These are for examples that you've got there as opposed to your real trading chart. Okay. Thanks, Jody. I'm sorry.
Yeah.
Let me let you run. I'm going to back out here.
Okay. So yeah. So this is it. Now let me show you how easy it is to spot the profit levels using the Wavy Tunnel Pro. Now, good segue, Raleigh.
I did not know.
I think you had my presentation. Come on. So this is what the setup looks like, and really yes, I use Fibonacci even with the Wavy Tunnel. Okay. But we're looking at levels where the market will come back to. When I see, that the market, when I'm placing a 61.8 profit target, I'm really happy because it's going to come back to this level at least. And then I would be looking for the next level. So we happen to set our profit targets before it reached the next level, but that would be my maximum target. And that is the 100% up here. And then we work backwards to set the profit targets. So, and this is okay, here's another example. Last week, I did take 4 trades in one day on 4 different currency pairs. So I'm just going to show you the results. Like I took it, and then the next day, the next morning, they were all in profit, and they were all profited out. This is the full Wavy Tunnel setup. It's the full Wavy Tunnel setup. So here we have the trend line. And yes, I've drawn the trend lines a little bit differently because we have these semaphores on top, but that's part of the strategy. It's a little bit different. And so I bought at 112.85 and then set the profit targets and at 113.42. In this case, I just used one profit target, okay? I just used one profit target for all 4, okay? Because it was an overnight trade, and I set the profit targets at certain levels. So I literally set it at this high point. It got triggered. And then here as well, even though I measured, like I could measure the Fibonacci all the way down, I wasn't looking for a major move. I just wanted to, I just wanted to take profits at the previous swing high. Okay, so that's what I did, right? to follow the methodology that we use today, I would have set, or you could set a Fibonacci retracement from this swing high to this swing low, and then work backwards and take your profits along the way. I set it at the 100% because I was pretty convinced that it would go there. And so that's what I did. And then here's another one where I took it on the trend line break, and I did my analysis. I looked at the awesome oscillator and saw divergence. Here we have triple divergence. Okay, we have the trend line break, and then on the 1, 2, 3 reversal, I triggered the trade and took it, and then took profits there. The fourth trade was the euro pound, another trend line break. So these were extensive moves up, and then we had a beautiful divergence. You can see that where price made a higher high and the awesome oscillator made a lower peak. And then we had a beautiful 1, 2, 3 reversal pattern and a trend line break. So I triggered the trade and took the profits here. These were real trades taken. Yeah, so those were just like 4 examples. These were literally done in these trades were taken in 1 hour, and then the next day they were all profited out. So let's just review.
So, hey, Jody, just on that point, because there was a question that popped in here that kind of quickly before you move on from your slides there. The question is, where do you start counting the waves? Is that a deeper discussion?
No, you start counting the waves at the high or the low on the visible chart. Now, if you're counting the waves where you really want to count waves and keep them on your charts, you're going to start on the monthly chart, and then you're going to work down to the current time frame. So if you have charting software, like this is, if you have charting software that can do that for you, where it keeps the wave counts on all of the charts, you're going to start at the highest time frame, and that might be labeling it, an A, B, C, for example, and then you're going to move down. If you're just trading, let's say this is the hourly chart, and you want to start from the hourly chart, you can do that too, and you want to start from the low or the high of the visible chart. So in this case, this is a 5-wave move up, 1, 2, 3, 4, 5, and I can see that because I usually label my wave 3 at a peak in the awesome oscillator, so right here, and then we have a wave 4 correction, a beautiful 3-wave, wave 4 correction, and then we make a new high. That's your wave 5 with divergence, and then we're looking for an ABC move.
Okay.
So the correction down. Okay, and sometimes this is an ABC, and then we have another move up, and then we come down again. It could be like we could have a double correction. The corrections can be simple or complex, but so you start your counting at the bottom of the price at the low on the visible chart in this example. Okay.
Okay, great. Thank you, Jody.
Yeah. We started out by looking at the candlestick patterns on a blank chart. And we were looking for reversal candlestick patterns, kicking off the move, the reversal move. Then we looked for divergence or a major peak on the previous swing move. Then we drew our trend line and we looked for a trend line break. Drawing the trend line and using a 1, 2, 3 reversal pattern is so that we don't get in too early. Since those were major moves down, you don't want to get in too early. If you do, then the market will move against you initially, and then you just have to get in again. But many traders, after if they take a losing trade, they're not there to get in again if the market turns around again. So I like to make sure that the market confirms its reversal, and the 1, 2, 3 pattern does that. The trend line break does that 90% to 95% of the time as well. So that's what we did, and then we looked at the Wavy Tunnel Pro. We set our targets using Fibonacci, and I also showed you the Wavy Tunnel Pro a little bit. And that's what we learned today. And this is a great little strategy. We also covered money management and trade management. There's a lot more to talk about, obviously, a lot more. But I think I covered like a nice amount for you today. So the Wavy Tunnel trades are broken down like this. We have 4 breakout trades. Breakout 1, breakout 2, breakout 3, breakout 4. Breakout 1 kicks off the move. Breakout 2 is the wave 2 retracement. Breakout 3 is trading the wave 3 trend. Breakout 4 is looking for the wave 5 move. And then we have our 2 end of trend trades called PW and fill the gap. That would be this piece over here. So it's really broken down. The Wavy Tunnel trades are broken down into the market cycle. Okay. Here's David P. from the UK wrote this. Once you master the simple concepts of using the Wavy Tunnel Pro strategy combined with the bungees and semaphores, you can make more accurate, high probability trades each day, resulting in more profitable trades. And that's really true. The students are just very excited about this because they're making, they're seeing results, and that's what we want as traders. We want to see results. This is the trading system that has worked for me over the past 30 years and counting. Now, when I say trading system, for me, it's Elliott Wave. I learned Elliott Wave analysis while I was at the bank. The Wavy Tunnel, 10 years old, but the Elliott Wave, that's the basis for everything that I do, and I've done that forever. I learned about it while I was trading in New York on Wall Street. And how did I learn that is we hired a technical analyst from the Chicago Board of Trade to be our analyst on the desk. And he really taught us all about technical analysis and Elliott Wave analysis. And it just stuck with me, from that point on, and I've really never veered from it. So what you see with me is always an Elliott Wave based basis, and the Wavy Tunnel is my chosen strategy because it follows the market map so beautifully. But this is not about me, it's about you. And I believe that if you apply this playbook in your trading, you can become consistently profitable and achieve your trading goals, whatever they are. The Wavy Tunnel Pro Lite is a solid master's in trading education for all asset classes, instruments, and time frames. If you want to remove uncertainty in trading, gain total clarity about what to trade, when, and how much, get massive confidence when you learn to identify high probability setups, and finally achieve consistent profits in your trading, then this is specifically for you. And this is for new traders or experienced traders. Many traders take the program that when they've traded for 3 to 5 years, and they take the program, and this seems to fill in all the missing pieces for them, which I love to see. The Wavy Tunnel Pro Lite 2020 has 3 sections. The first section is all about Elliott Waves and the market map, but it really teaches you about Elliott Wave analysis, about the trends, what kind of trends we have, what kinds of corrections we have, so that you can spot these patterns in the markets. And then section 2 takes the Wavy Tunnel Pro strategy and gives you example after example on how to find these trades and where to set your, how do you look at, how you do higher time frame analysis to take your profits and look for how far the market can move. And then there's a section on advanced Fibonacci, because as I mentioned, Fibonacci really forms the basis of Elliott Wave analysis and the Wavy Tunnel Pro strategy as well. The price, well, I've invested tens of thousands of dollars in training over my career, and this trading added to my experience. I could easily charge several $1,000s for this training. I had a student once that spent $50K in training before taking the Wavy Tunnel Pro and told me this program is even more valuable. But I'm not even going to charge a fraction of that. So this online program is equally valuable or more. And today you can enroll for one payment of $997. And the link is westmarktrading.com/FX. Okay. So what do you do next? Click the purchase button, get your login information, and you will have instant access to the Wavy Tunnel Pro Lite. Let me just tell you a little bit about what it is you have a complete program. All of the videos are there. It's a complete course. You get it it's lifetime. And I also did I did 27 live sessions starting in the middle of January until May. So you're going to have access to all of those sessions as well, looking at all the live markets. And then I'm going to be inviting you, I'm going to do some more live sessions in the fall that I'm going to be inviting you to if you want a refresher. But right now, you have the opportunity to study all of this, learn it, put it into practice, and then meet with me in the fall for live sessions. And I do have a 5-week guarantee. The bonus is that you get 2 months of the Wavy Tunnel Pro Desk membership, which includes a trade scanner for Forex, stocks, commodities, and cryptocurrencies, 4 London and New York trading and analysis rooms a week, trade with confidence videos with 2 to 4 actionable ideas every week, a psychology podcast, and our automated trading system. So just a few good trades like the examples I showed you will pay for this entire program. I'd like to share my experience with you on the Wavy Tunnel Pro program. When I first started trading Forex, I learned many systems using different types of indicators, but didn't have much success. I pursued Elliott Wave and loved how price action actually had meaning, but no one told me how hard EW was to learn and then practice with. I found Wavy Tunnel, which incorporates EW. That helped me take the next steps into becoming a better trader. I have now progressed and passed the test with one prop firm and well on the way of passing another prop firm's test. That's from Jason H in Canada.
Wow, that's terrific.
Yeah. So that's it. Are there any questions?
I think what I tried to do is to address some of the questions that came up in the presentation. There were several questions about the slides themselves, like what time frame are the lines and things of that nature. And I think I would just encourage people to go to your website or contact you directly for answering those kinds of questions.
Okay, sounds good. Yeah, and I put my email address here in case anybody has some of those questions that went unanswered.
Yeah, that sounds great. You can go to Jody at forextradersedge.com, folks, and you can address those questions to Jody. Well, Jody,
at fxtradersedge.com.
What did I say?
Forex.
Oh, Forex, yeah, fxtradersedge.com. So anyway, folks, I mean, that was a fast hour, Jody. Thank you so much for your time, spending it with us today and the time that you took to prepare that presentation. Really appreciated it and really enjoyed your step-by-step process for how you trade the markets, because actually, that's why the people are here today. The markets are going crazy. And yeah. How does an expert or a pro like you deal with what's going on? Well, you're not running away from it. You see opportunity in the volatility. And I think one of the takeaways that I had, I mean, you said that you've been practicing this for 30 years, at least Elliott Wave analysis, and the Wavy Pro was 10 years ago. And this analysis has stood the test of time. It's seen all kinds of market conditions, and you haven't during that time abandoned it as an approach to the market. It's just reinforced how you trade the markets.
Absolutely. I love it.
All right.
And I love the market volatility. And thank you so much. This is fabulous. And thanks, Raleigh. Always good to see you.
Nice to see you too, Jody. Thank you so much. And